Most people, they spend years chasing the perfect investment strategy only to end up confused, stressed, and underperforming the market. While the investors, they quietly building real wealth, are usually doing something insanely simple. And they're not day trading. They're not buying random hype stocks from TikTok. They're not, staring at the charts all night trying to predict the next crash. But in reality, many millionaires, are using a boring three fund portfolio that takes almost no time to manage and costs very little money. And historically, it beats the majority of actively managed investors over the long run. And the crazy part is, most people ignore it because it sounds too simple to work. But simplicity is exactly why it works. The more complicated your investing becomes, the more mistakes you usually make. And today, I'm breaking down the only three funds most people will ever need and why this strategy has exploded in popularity and how it can quietly build massive wealth without turning investing into a second job. First, okay, let's cover something. Let's understand the real goal of investing because most people already start with the wrong mindset. Your goal is not to become a stock picking genius. Your goal is not to impress people with complicated financial language. Your goal is to grow wealth consistently while minimizing unnecessary risk, fees, the stress, and emotional decisions, and that's it. The problem is the financial industry often makes investing sound incredibly complex because complexity keeps people dependent on advisors, expensive funds, subscriptions, and constant market commentary. But the data has repeatedly shown the simple low cost index investing outperforms most active strategies over long periods of time. And that's where the three fund portfolio comes in. This strategy became popular through the Bogle investing community inspired by John Bogle, Bogle. I don't know if it's Bogle or Bogle, but the founder of the Vanguard and one of the biggest advocates for low cost index funds. The idea is incredibly straightforward. Instead of trying to pick winners, you simply buy almost the entire market through three diversified funds. Fund number one is a total U.S. stock market index fund. This fund gives you exposure to thousands of American companies all at once. Instead of betting on one company like Apple or Tesla, you own a tiny piece of nearly the entire U.S. economy. That means large companies, mid-sized companies, and small businesses are all included. And when America grows, your investment grows alongside it. And some of the most popular examples are Vanguard Total Stock Market ETFs, Fidelity Total Market Index Funds, or Schwab US Board Market ETF. The exact ticker doesn't matter nearly as much as understanding what the fund actually does. It spreads your money across thousands of businesses, which massively reduces the risk compared to betting on individual stocks. And one company can fail, entire economies usually recover and continue growing over time. And historically, the US stock market has averaged around 7 to 10% annual returns before inflation over very long periods. And of course, there are crashes, recessions, and ugly years mixed in. But over decades, the trend has consistently gone upward. Fund number two is an international stock market index fund. This is the part many American investors skip because they assume the US will always dominate forever. Maybe it will, maybe it won't. The point of diversification is admitting nobody knows the future with certainty. International funds give you exposure to companies outside of the United States, including Europe, Japan, Canada, emerging markets, and many other economies. In some years, international markets outperform the U.S. significantly. In other years, well, they lag behind. But holding both reduces your dependence on a single country's economy. Think about it like this. If all your investments rely on one nation performing well before you're taking a concentrated risk, whether you realize it or not, international diversification spreads that risk across the globe. Popular examples include Vanguard Total International Stock ETF or Fidelity Total International Index Fund. These funds contain thousands of companies worldwide, again, keeping things diversified and simple, though. So, let's get on to fund number three. It's a total bond market index fund. This is the least exciting fund and usually the one younger investors want to ignore. But bonds serve an important purpose. Stocks are powerful for growth, but they're volatile. And bonds help stabilize your portfolio during rough market conditions, and they generally fluctuate less than stocks and can provide income through interest payments. And when stock markets crash, bonds often hold up much better, which can reduce the emotional panic that causes investors to sell at the worst possible time. A total bond market fund gives exposure to government bonds, corporate bonds, and other fixed income investments. Popular options include the Vanguard Total Bond Market ETF or the Schwab US Aggregate Bond ETF. And now here's where people overcomplicate things, though. They start asking the perfect percentage for each fund. The truth is, there's no magical allocation that guarantees success. Your percentages mainly depend on your age, your risk tolerance, and time horizons. Younger investors often hold more stocks because they have decades to recover from market downturns. Older investors, nearly retirement, usually increase bond exposure to reduce the volatility. One common example for a younger investor could be 60% US stocks, 30% international stocks, and 10% bonds. Another person may choose 70 to 20 and 10. And someone close to retirement might prefer 40% US stocks, 20% international stocks, and 40% bonds. The key point is not obsessing over tiny allocation differences. The biggest factor is staying invested consistently over time, because consistency matters far more than perfection. And one of the biggest advantages of this strategy is extremely low fees. Most actively managed mutual funds charge expensive ratios that slowly eat away at returns year after year. A 1% annual fee may not sound huge, but over decades it can cost you hundreds of thousands of dollars due to compounding. Low cost index funds, though, often charge tiny fractions of a percent, and that means more of your money stays invested and compounded for your future instead of enriching fund managers. Another huge advantage is simplicity. Simplicity reduces the emotional mistakes, and most investors underperform not because markets fail them, but because emotions destroy discipline. People panic during crashes and sell low, then they get excited during bubbles and buy high. They constantly chase performance instead of stacking with a long term plan. A simple three fund portfolio helps remove the urge to constantly thinker with your investment or tinker with it. You stop trying to predict headlines and start focusing on time in the market instead of timing the market. Rebalancing is another important concept. And over time, certain parts of your portfolio will grow faster than others, and maybe US stocks surge while bonds barely move. Rebalancing simply means adjusting your investments back to your target percentage periodically. And some people rebalance once a year. Others do it when allocations drift too far. And this forces you to sell portions that become overweight and buy areas that become underweight, which creates a disciplined buy low, sell high behavior automatically. Now, let's address the biggest criticism people throw at this strategy. They say it's boring. And honestly, they're right. It is boring, but boring investing is often incredibly effective. Excitement is usually expensive in the investing world, and the people constantly chasing meme stocks, options trade, and speculative hype may look exciting online, but many eventually lose money because high risk cuts both ways. Wealth building usually looks repetitive and uneventful. It's steady contributions, long term thinking, ignoring noise, and letting compounding do the heavy lifting over decades. Another mistake people make is waiting too long to start because they think they need huge amounts of money. You don't. The biggest advantage is investing is time, not perfection. Even small, consistent investments matter. Man, my nose is mad. My nose is itching. Because compounding accelerates over long periods. And someone investing a few $100s a month consistently for decades can potentially outperform someone who waits years trying to find the perfect strategy. Starting early matters more than being brilliant. There's also the temptation to constantly check your portfolio every day, and that habit can become destructive because markets naturally fluctuate. A normal market correction can suddenly feel like a catastrophe when you stare at the real red numbers hourly. Long term investors need emotional distance from short term volatility. The market has survived wars, recessions, political chaos, inflation spikes, housing crises, and pandemics, and countless predictions of doom. Yet over long periods, diversified markets have continued growing because businesses adapt, they innovate, and generate profits. That doesn't mean future returns are guaranteed, but history strongly rewards disciplined long term investing. And here's the truth most people don't want to hear. Building wealth is usually not about finding secret investments. It's about, avoiding the stupid mistakes. Consistently over decades, the three fund portfolio works because it removes the complexity, it lowers the cost, increases diversification, and encourages the discipline. It turns investing from a stressful game into a repeatable system. And sometimes the smartest financial move is accepting that you do not need to outsmart the market to become wealthy. You simply need to participate in it consistently while avoiding emotional decisions that destroy your long term returns. You know, the investor who quietly wins are usually the ones doing less, not more. They buy diversified low cost funds, keep contributing regardless of the headlines, and rebalance occasionally and let time do its job. That approach may go viral on social media because it's not flashy enough. But decades from now, the results can speak louder than any hype ever could. Thanks for watching today's video. If you found value in today's video, please subscribe. I would highly appreciate it. That's what this channel desperately needs, a subscription, and YouTube says I can't grow without it. So if you found value today, just subscribe. That's all that matters to me. Thanks for watching, and we'll see you guys tomorrow.